Good morning. Welcome to Friday's Market Wrap-Up. Matthew Buckley, the Chief Investment Strategist at Wealth Creation Investing. And wow, what a couple days it's been. Two of the most volatile days in this year, and we've seen the biggest losses in stocks year to date. Bonds also got hammered, commodities got hammered, and not only because of our markets, but also because of what's going on overseas in China. So folks, the world really is flat now. Global markets are interconnected, and very, very strong correlation between these markets, which can't necessarily be good. For the past 2-3 weeks, we were moving around because of the Nikkei, right? The Bank of Japan, Japan had good GDP numbers. Nikkei rallied, we rallied. Bank of Japan said, hey, we're going to sit on our hands and maybe not ease as much as we thought. And the world markets, the Nikkei, and then our markets went into a temper tantrum. Wednesday, we saw what the Fed did, and our markets have had 2 full days of temper tantrums. Now, the futures and the market might have a little bit of a, what I called yesterday in our live trading session, a relief-stop-the-hemorrhaging. Probably not a relief rally, folks. I think we're back to the time, kind of like the financial crisis, where nobody wants to go long into the weekends because anything can happen over the weekends, especially Sunday night with the Asian Open. Asia implodes. We're going to have a gap down on Monday type of thing, or a gap up if something great happens in Asia. So traders probably not wanting to go long into the weekend, so I don't expect market action to be super stellar today with a ginormous relief rally. I think we kind of just move sideways as the markets rub their faces and from the smack that they had on Wednesday because the Fed's serious, right? The Fed is more or less saying, hey, even though he said I'm easing up on the accelerator, not stepping on the brake, he shot across the bow of the markets. We know what's coming. And, there a lot of economists and 500-pound heads are saying, hey, they'll probably ease off to $65 billion a month, maybe in the fall, September-ish. But the markets are going to eventually recover from this, right? Yes and no. James Bullard, the St. Louis Fed president, had a good point. I got to tell you, folks, the macro, and I covered this in my live trading session yesterday that was open to everybody at WCI and Top Gun Options, that the macroeconomic data just are not good. The data are horrible, right? Huge macroeconomic misses. And the Fed is saying, well, we think the economy can stand on its own. The Bernanke really has created this Frankenstein where it's turning on its master, so to speak. Markets going up, great, awesome. That wealth effect that Bernanke wanted. Everybody feels wealthier, right? I'm sure you do. Of course you don't. You're on Main Street. Wall Street, I can tell you, feels a hell of a lot healthier. But the economy is still stuck in neutral. Yeah, you can see green shoots in housing, and for every green shoot in housing, I'll show you a huge brown shoot. Manufacturing. Inflation's not a problem right now, but we might actually be running into a deflationary period. So we have a whole cauldron of bad stuff. So in my opinion, the Fed tapering, when I laid out the 3 scenarios of the Fed tapering, the good, the bad, and the ugly, we got the ugly. We definitely didn't get the good. The good with the Fed leaving would have been, hey, the economy's doing great, and it in fact was. And he was passing the baton to us to go and finish the race on our own. That didn't happen, or at least he poorly telegraphed that this is why we're getting out, because economic conditions are great. They're not. As Bullard said, a more prudent approach would be to wait for tangible signs that the economy was strengthening and that inflation was on a return path target before making such an announcement. So very, very interesting times that we live in, folks. Not too much on the economic flight schedule today. It's going to be all quiet on the Eastern Front here. No big announcements. But yesterday the conference board's indicator was soft. Philly Fed was blew it out of the water. So did the Empire manufacturing the other day, right? But every metric in there was negative, and their forecast for the next 6 months was extremely gloomy. So I got to tell you, folks, it's the Fed's kicking us out of the nest, and I don't know if we can fly. Now, if you joined me yesterday morning for our weekly options live trade brief over at Top Gun Options, which was open to everyone, even non-subscribers. I put on a bearish double vertical on the SPX as soon as the market opened. It was a bear call spread on the 1640, 1645, and a bear put spread, the 1600, 1595 bear put spread. And obviously with the SPX imploding to 1588, this thing made $1,000, $1,500 in a matter of hours. So really nice trade on that. And in the primary life trade brief model portfolio, just before the Fed announcement came out, I put on a bullish double vertical on the VIX, on the volatility index, that made $1,600, 133% return in a day. So that's a pretty healthy gain. So I think we're going to see, like I said, a little bit of a and remember, folks, and I'm going to talk about this at 1 o'clock. If you want to join me at 1 o'clock, I'm doing kind of an open forum. I'm going to be talking about where I think or what's happening, where I think we're going to go from here. But take a look at volatility, folks. Volatility does not tend to stay elevated for too long. Last time we saw these 20s was right around the fiscal cliff, right? And what happened? Clown car in Washington, kicked the can down the street. Had a freak out in February, and then volatility imploded. Had a freak out in April, and then volatility imploded. We're having a freak out right now. Volatility does not stay elevated for too long, historically. I use the analogy, it's like, volatility being this elevated means you're on a treadmill at a 10 incline in 10 miles per hour. I mean, I'm a pretty healthy guy, and I can do that, but only for a little bit. I need to get back to my resting heart rate, which for the VIX recently has been right around this 13 level. And it seems like every time we get down to 13, everybody looks around and says, hey, everything's great, everything's happy. Wait, no, it isn't. Let me get some protection on in case something freaks out, and then we get this. So we're going to be talking about the VIX this afternoon at 1 o'clock. Check your email box for details and how you can just come this afternoon at 1 o'clock. Even if you don't, just click on that link anyway so you can watch the replay maybe over the weekend so you can get your mind right with how I think to play this market, where we're going from here, the next Fed moves, and some potential trades. Okay, so I got to run. Going to be a very interesting day. It's expiration as well, so I got to manage a bunch of positions. But I look forward to seeing you at 1 o'clock if you can make it. Happy hunting. Make sure you hedge, and have a great weekend. I'll talk to you for Monday's market outlook.